Welcome to an in-depth exploration of growth equity, a fascinating and crucial segment of the private capital markets. In this video, we'll uncover what growth equity is, its unique position bridging venture capital and private equity, and how it fuels high-growth companies. This content is for aspiring finance professionals, entrepreneurs seeking funding, and investors looking to understand the nuances of private market strategies. By the end, you'll have a comprehensive understanding of this powerful investment vehicle. At its core, growth equity occupies a strategic middle ground, often described as the bridge between early-stage venture capital and mature private equity buyouts. Unlike VC, which focuses on nascent ideas, and traditional PE, which targets mature, often leveraged buyouts, growth equity targets established, rapidly scaling companies that are past the initial startup phase but not yet mature enough for a traditional leveraged buyout. Its core principle is investing in growth, not just leverage. Now let's delineate how growth equity stands, apart from venture capital. While both invest in high-growth companies, their approaches differ significantly. Venture capital typically invests in companies at their seed, Series A, or Series B stages, early in their life cycle, often pre-revenue or with minimal revenue. The risk profile is inherently high, as many startups fail. Growth equity, however, steps in at later stages, often Series C, D, or beyond, when companies have proven products, established markets, and significant revenue traction. This later stage inherently carries a lower risk profile compared to early-stage VC. The use of capital also varies. VC funding is often used for product development, market validation, and initial team building. Due diligence for VC is heavily qualitative, focusing on team, market potential, and disruptive innovation. In growth equity, capital is primarily used for scaling operations, expanding into new markets, making strategic acquisitions, or optimizing existing business models. Due diligence is more quantitative, emphasizing revenue growth, customer retention, unit economics, and operational efficiency, reflecting a more mature business. Next, let's explore the distinctions between growth equity and traditional private equity buyouts, which often focus on mature, cash-generating businesses. A key differentiator is control. Traditional PE buyouts almost always involve acquiring a majority or even 100% controlling stake in a company. Their strategy often involves significant operational restructuring and financial engineering to drive value. Growth equity, conversely, typically takes a significant minority stake. They partner with founders and management, providing capital and strategic guidance without seeking outright control. This allows founders to retain ownership and continue leading their vision. The use of debt is another stark contrast. Private equity buyouts heavily rely on leveraged financing, using substantial amounts of borrowed money to fund acquisitions. This amplifies returns but also significantly increases risk. Growth equity, on the other hand, uses minimal or no debt in its investment structure. Their primary return driver is the organic growth of the company's revenue and profitability, rather than financial leverage. The growth equity playbook is about partnership and value creation beyond just capital injection. Growth equity firms don't just provide money, they bring strategic guidance, drawing on their deep industry expertise and networks. This includes helping companies with market expansion strategies, competitive positioning, and M&A activities. Understanding the characteristics of growth equity firms themselves further illuminates their unique position in the investment landscape. Growth equity firms often have specialized teams with expertise in specific sectors like software or healthcare, providing targeted support to their portfolio companies. Fund sizes typically range from hundreds of millions to several $1 billion, allowing them to make substantial investments without requiring a controlling stake. They also leverage extensive value-added networks of industry experts, potential customers, and talent, which they connect to their portfolio companies for accelerated growth. Unlike the shorter holding periods often seen in traditional PE, growth equity firms typically adopt a longer-term view, often holding investments for 5 to 7 years or more. This aligns with the time required for high-growth companies to mature and achieve significant scale, allowing them to truly benefit from the strategic guidance provided. Growth equity finds fertile ground across various sectors, particularly those characterized by rapid innovation and scalability. The technology sector is a primary focus, with significant investments in SaaS, software as a service, companies due to their recurring revenue models and scalability. Fintech, transforming financial services through technology, is another hotbed, as is e-commerce, driven by the ongoing shift to online retail. Beyond traditional tech, growth equity is increasingly active in sustainable technology, investing in companies addressing climate change and resource efficiency. Healthcare technology and services, driven by innovation and demographic shifts, also present significant opportunities for growth stage investments. To truly understand growth equity, it's helpful to look at some of the pioneer firms and major players in the space. Firms like General Atlantic, TA Associates, and Summit Partners are considered pioneers in the growth equity space, having specialized in this strategy for decades. They have a long track record of partnering with founders to build category-leading companies across various industries. Additionally, many large private equity firms have recognized the attractiveness of growth equity and have established dedicated growth arms, such as KKR Growth and Blackstone Growth. These divisions leverage the broader resources and networks of their parent firms while focusing on the unique aspects of growth stage investing. While highly rewarding, growth stage companies face their own set of challenges. Intense competition for market share, especially in rapidly expanding sectors, can be fierce. Balancing aggressive growth with the need to achieve profitability is a constant tightrope walk. Furthermore, scaling operations often requires professionalizing internal processes, hiring experienced management, and building robust infrastructure, which can be a significant undertaking for entrepreneurial teams. The future of growth equity looks bright. We anticipate continued growth in capital deployed, driven by an ever-increasing number of innovative, high-growth companies. The strategies employed by growth equity firms will likely become even more sophisticated, with deeper specialization and more tailored value-add services. Moreover, growth equity is becoming an increasingly important exit channel for venture-backed companies, offering an alternative to IPOs or traditional PE buyouts for companies seeking further capital for expansion. In conclusion, growth equity truly offers the, quote, best of both worlds, combining the exciting growth potential characteristic of venture capital with the more structured, value-added approach and lower risk profile typically associated with private equity. It's a powerful and evolving force in private markets, essential for understanding how today's leading companies scale. Please remember, this video provides educational content and should not be considered financial advice. Always consult with a qualified financial professional for personalized guidance. Thank you for watching.